Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Sponsored by WFGinsurancequotes.com.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having essential estate planning documents can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, WFGinsurancequotes.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, WFGinsurancequotes.com. The chat box is open, so tell me your name and where you're from, and I'll get to questions as time allows. I see some names in the chat box already. Hi, Jacob from Texas. Good to see you. Carolyn from Virginia. Awesome. Good to see you too. Yes, Troy, I see you. I see you from hot Atlanta, Georgia. I see you. Glad you made it. Awesome. Well, thank all of you for joining. Today's webinar is entitled Creating Lifetime Income with 401k Rollovers. And Mike mentioned a person can either learn things the easy way or they can learn things the hard way. And in my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that there were certain policies that could actually help you while you're alive. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. And as a token of my appreciation, everyone on the webinar today will be given access to a free ebook that you can download after the call. I'm a part of an online educational program called SafeMoney.com. And SafeMoney.com is a non-biased guide to retirement income planning and wealth protection strategies. And I wanted you to have access to the information on this website right away because this has been a tremendous resource for people that I'm working with. So, regardless of where you are in your retirement journey, you will find that there are many helpful pieces on there. Now, let's jump in. A 401k can be a great way to accumulate assets for retirement, but it provides no certainty of what kind of standard of living you'll be able to afford once you retire. Whether you want to retire to a quiet life on the beach or spend your golden years globetrotting to exotic locations, one thing is for sure: retirement is likely to be the most expensive thing you ever pay for. And unlike other major life purchases, such as cars, homes, or college, there are no loans for retirement. That means you'll have to save for it. Despite their popularity today, 401k plans were created almost by accident. It started when Congress passed the Revenue Act of 1978, which included a provision that was added to the Internal Revenue Code, Section 401k, that allowed employees to avoid being taxed on deferred compensation. Today, two traditional sources of retirement income, Social Security and company pension plans, are figuring less and less in people's retirement planning. By some estimates, these two sources will provide just 20 to 25% of what those in the middle to upper income group will need to live comfortably when they retire. The forecast is cloudy for Social Security. Some actuaries believe either the system is going broke and will be out of business before today's younger workers come close to retirement age, or Social Security will provide only a marginal contribution to the incomes of those other than the poorest retirees. According to the newest report from the Social Security Administration Board of Trustees, the Social Security program is set to run aground as early as 2034. This is when the supply of U.S. Treasury bonds in the Social Security system runs out, and the program will either have to find new additional sources of funding or fund benefits out of incoming payroll taxes. So what are some of the roadblocks to retirement? One of the biggest roadblocks is inflation. Inflation is a constant, steady erosion of money's value. The amount of erosion varies. In some years, the rate of inflation is higher than in others, but the effect of inflation never changes. The cost of living keeps going, so you need more money just to break even. Another roadblock to consider is taxes. Just as inflation can erode your savings, income taxes can have a dramatic effect on total return, negating as much as a third of your earnings. Consider carefully your savings vehicles to minimize tax bite and maximize earnings. Consult your tax advisor with any questions on taxation issues. Then, of course, there's procrastination. Procrastination by far is the most dangerous retirement roadblock. Each year that saving is postponed, you lose the advantages of compound growth in that year. In exchange for a higher standard of living now, you may deteriorate your standard of living later during retirement. In addition, retirees may have inadequate savings. Having enough money for retirement can be one of the biggest financial concerns among Americans today. According to a recent survey by the Employee Benefit Research Institute, 70% of people polled said that future retirees will be financially worse off than current retirees. Almost the same number, 68%, think the percentage of elderly people living at or below the poverty line will increase in the future because of inadequate savings. Some of this pessimism, particularly among younger people, comes from low expectations about the future of Social Security. 72% of people think their benefits will be cut off or even eliminated altogether by the time they retire. The following video gives us an overview of retirement realities.
Retirement realities. There once was a time when retirement was simple. All you had to do was hold down a job, and one day you'd find yourself comfortably retired. You could count on financial support from Social Security and possibly a pension, and you may have had some personal savings as well. Not anymore. The future of Social Security is uncertain, and most pensions have gone away. That means to make sure you have enough money to live on in retirement, the responsibility lies primarily on you. In recent years, you may have been saving more of your own money for retirement in personal accounts like 401ks and IRAs and investments like stocks. But as we saw in the past few years, that can be risky. Many people lost a significant portion of their retirement savings, so they've had to defer their retirement dreams and work longer in an attempt to rebuild what they lost. The realities of retirement can be pretty daunting, but the possibility of outliving your retirement savings can be even more daunting. Fortunately, there are some things you can do to help protect yourself. No matter how far you are from retirement, start planning for it today. The fact is, the sooner you plan, the more likely you'll be able to retire the way you want. You also may need to save more than you think. That's because we're living longer than ever before. It's not uncommon to spend 20 years or more in retirement, so you need to make sure your money lasts as long as you do. There's also the chance you may have to retire earlier than you planned because of a job loss or health issues. So saving more can help you handle unexpected events. A longer retirement can also mean higher living expenses because of more leisure activities, increased medical costs, and of course, inflation. If you're close to or in retirement, it's important to make sure your money lasts, and that means you need to stay active in managing it. Here's how to start. First, seek clarity. Look at the facts. Determine exactly how much money you've saved up. Think about how much money you'll need each month, not just for basic necessities, but because every day is like a Saturday in retirement, you may end up spending more than you expect on day-to-day activities. You should also decide if you want to leave something to your heirs. Next, assess your comfort level. How worried are you with the thought of losing money? If it keeps you up at night, consider protecting a portion of your retirement savings. You also need to think about the cost of living and how it can increase over time. After all, the longer you live, the more things are likely to cost. When you were working, you may have gotten raises or cost of living increases to help you keep up with inflation. It's important that your retirement income keeps pace with inflation too. But now, it's up to you to find a way to get your own increases. Last, you should plan for certainty. You'll want to make sure you can't run out of money no matter how long you live. That involves creating a plan for guaranteed lifetime income. The good news? There are solutions and people that can help you do all of that. One way is with annuities and some of the features they offer as part of your retirement portfolio. A financial professional can help you determine which annuity might be right for you.
First and foremost, rolling a 401k into an annuity contract provides insurance on your retirement investment. The two largest assets of most households are the house and their employer-sponsored 401k plan. Most people wouldn't dream of not having insurance on their home. Yet, many investors approaching retirement have no insurance on their retirement plan. Rather, it can fluctuate based on the fund manager and market dynamics. Annuities can provide protection in a down market, guarantee lifetime income, and the ability to guarantee a certain amount is passed on to heirs. These can be considerable advantages to all investors, but in particular, those who have accumulated substantial assets and then have the misfortune of retiring in a down market. So, can you roll your IRA or 401k into an annuity? The answer is yes. You can roll your IRA or your 401k into an annuity. But the big question is this: should you? Before you can make an educated decision about transferring money from a 401k to an annuity, there are a few variables we need to look at. What type of annuity are you considering? Are you done contributing to your 401k? Are you retired? Do you know how much money you might need in the future? Do you have a trusted advisor? We'll answer all these questions, but first, we want to make sure we're all on the same page. So what exactly is a 401k and what is an IRA? Does the type of IRA traditional, simple, or Roth change the decision-making process? Let's look. A 401k is a retirement savings plan that your employer often contributes to. A 401k helps employees save a portion of their pre-tax paycheck for retirement. Most 401k plans offer a spread of mutual funds, but this can vary. There are caveats to having a 401k, such as being unable to use any of that money for a certain amount of time, also called vesting, and rules about withdrawing your money before retirement age, and fees. An IRA, or individual retirement account, on the other hand, is exactly how it sounds. It's just a retirement account. Most IRAs are traditional IRAs. This just means that the money in the retirement account is pre-taxed. Another type of IRA is a simple IRA, which stands for Savings Incentive Match Plan for Employees. With a simple IRA, both the employer and the employee contribute to a traditional IRA. And this type of IRA is best suited for small employers who might not be able to afford conventional retirement plans, but they still want to help their employees save for retirement. Finally, there are Roth IRAs, which are less common. With a Roth IRA, you put taxed dollars, money that has already been taxed, into the account so that when you retire and you start taking that income while you don't get taxed. It's basically a case of get taxed now rather than get taxed later. A 401k rollover refers to the process of taking the money out of your 401k and moving it into a different retirement plan. This typically takes place when you leave your company or retire, and is also referred to as separation of service. There are several rollover options available to you once you separate from service. One option is to take the cash. With a lump sum payout, you can count on losing a huge chunk of your savings to taxes. If you are over 59 and a half and you choose to cash out the 401k, it will be taxed as current income. Your company will deduct 20% of your savings and hand it over to the IRS as a prepayment on your income taxes. If you choose to reinvest it, you will have a lot less money to work with. If you are under 59 and a half, you may be forced to pay a 10% early withdrawal penalty in addition to the 20% paid to the IRS. If you take the cash all at once, you will be required to report the entire amount on your income taxes for that year. This amount, in addition to your other annual earnings, can bump you into a higher tax bracket. In either case, cashing out your 401k is generally one of the worst decisions you can make when it comes to optimizing your retirement dollars. When some people leave their job or retire, they leave their money in the 401k plan. Your current company is obligated to let you keep your money in its plan, even if you leave, as long as it exceeds $3,500. If you go to a new employer, you can usually transfer your old 401k money into the new employer's 401k account. You will now have the advantage of one account statement instead of two, and your investment options will be different in the new plan. But keeping your money in the 401k is next to cashing it out, the second worst thing you can do with your retirement money. The money is still restricted to a defined set of investment options dictated by your company's plan. All 401k plans have limited investment options, no safeguards against losing your principal, and no income protection for your retirement years. Better than leaving your money in the 401k is to roll it into an IRA. There are a wide variety of IRA investment options out there, and you can choose one that you like, rather than be tied to the investment options pre-selected in your 401k. However, IRAs do not provide safeguard of principal or benefits such as income protection as you get older. Your other option is to roll your 401k into an annuity. When you leave your job for a new one or you retire, you have a one-time opportunity to take the money from your 401k account and transfer it into a better investment vehicle, like investments with more flexible investment options, safeguards against losing your principal, and income protection for your retirement years. We firmly believe that investors retiring or changing jobs should, at a minimum, look into seizing the opportunity to transfer their investment dollars out of the generally restrictive 401k plans and into more flexible plans such as annuities. Rolling your 401k over into an annuity gives you a continued tax shelter while permitting you a huge range of investment options, guarantee of principal options, and living and death benefits that can protect you and or your family, whether the stock and bond markets go up or down, and regardless of how long you live. If you choose to roll your 401k into an IRA annuity, there are two primary types, immediate and deferred. With an immediate single life annuity, you will receive one check per month for the rest of your life, no matter how long you live. The amount of this monthly check is determined by the size of your account, the interest rates at that time, and your life expectancy. With a joint and survivor annuity, the amount of each check will be 10% to 15% smaller because they will be sent every month for as long as you or your spouse is alive. You can also opt for a life with 5, 10, or 20-year certain contracts, which will guarantee that monthly checks are sent to your heirs after you and your spouse are deceased. With an immediate annuity, you are giving up control of your principal, and therefore it is important to understand that you are rolling your money over into an annuity in exchange for a series of payments. With a deferred annuity, you maintain control of your principal and can receive guaranteed payments while benefiting from potential upside in the stock market. This is accomplished through the purchase of additional riders that will guarantee at a minimum a 5 to 7% worst case return on your money. But if the market does better, you are guaranteed the higher return and can lock in your new higher principal value to increase your income. The following video gives us a quick recap.
Despite the fact that a 401k is one of the most common employer-sponsored retirement plans, many employees may not fully understand their options for accessing or moving their money when they retire or leave their current company. One option is to simply take the cash. If you do, however, you will be subject to appropriate income taxes, and if you are under 59 and a half years old, you will be subject to a 10% withdrawal penalty and possibly even a 20% federal withholding tax. Because of the potential penalties and tax implications, this is usually not the most favorable decision. Option 2 is to just leave the money in the 401k. Your employer is obligated to allow you to do this, and if you go to a new employer, you even have the option to transfer the money into the new employer's 401k plan. Option 3 is rolling the money into an IRA. There are a wide variety of IRA investment choices, and you can select the one you like best, rather than being tied to the options that were available with your 401k. Option 4 is rolling the money into a fixed annuity. Many individuals appreciate this option because it can protect their principal from market losses, provide tax advantages similar to an IRA or Roth IRA, allow guaranteed retirement income for life, and even provide a potential death benefit for their family. Retirement and 401k management can be confusing, so we invite you to contact us and schedule a complimentary consultation. We'll review your options and assist you in making the right decision for your future.
Rolling your 401k over into an annuity gives you several advantages. The biggest advantage is guaranteed principal. Principal is guaranteed with a 401k rollover annuity, while principal is not guaranteed with mutual funds, stocks, and bonds associated with your 401k or IRA investment. The next advantage is lifetime income and inflation protection. By rolling a 401k into an immediate annuity with a lifetime income benefit, an investor can enjoy an income stream based on a predetermined and guaranteed rate, even in a down market. Recent market turbulence only serves to strengthen this point. Throughout the country, millions of workers approaching retirement have discovered that their plan balances are now too low to provide them with the income they need when they stop working. Furthermore, in addition to providing protection to one's beneficiaries, certain immediate annuities have inflation adjustment features to ensure that lifetime income keeps up with the increased cost of living. With immediate annuities with life contingencies, you cannot outlive your money. As long as you are alive, the insurance company is obligated to send you a check every month. Next, you have someone looking out for your investment. Once you retire, no one is contributing to your 401k any longer. What happens at this point is that no one is looking out for your investment. Your 401k might do well, but it might not. Oftentimes, you'll get a monthly statement in the mail, and you'll have no idea what it's even saying. Having a more hands-on approach with a qualified agent gives a ton of clarity and peace of mind. After all, this is your life savings. You want to know that it's being taken care of. The next advantage is safety. When you retire, you're moving from an accumulation stage to a preservation stage. When we move into the preservation stage, we have to adjust our investment strategy. You want to be more conservative and put safety as a higher priority over risk. Safety first, competitive interest rates later. Keep in mind that the current interest rates on fixed annuities are some of the highest we've seen in recent years. So don't think you're trading off competitive interest rates altogether. If you don't know how much money you might need in the near future, it's risky to put your money into an annuity. Since an annuity is a guaranteed contract, that money would be locked up for a few years. Even though you can have a 10% free withdrawal, it may or may not be enough to cover your expenses. For example, if you want to buy a new car and you need more than 10% of your investment, that would be a big drawback. That's why we recommend having a financial needs analysis done first. It will give you a calculated view of how long your money will last, give you recommendations, and take into consideration how your monthly spending will affect your nest egg. Everything from inflation to food, mortgage payments, insurance, utility bills, income taxes, credit card debt. All these expenses need to be budgeted for, and a financial needs analysis allows you to take the uncertainty out of the equation. When you turn 70 and a half, you are required to take out a required minimum distribution on any retirement savings account, be they IRAs, 401ks, etc. The money in your retirement account is pre-taxed with the understanding that you'll start withdrawing at 70 and a half. Why? Because the government wouldn't let you get away without ever paying taxes on that money. So, once you turn 70 and a half, those withdrawals must begin no later than April 1st of the following year. Keep in mind that you do have to take withdrawals, but you don't have to spend it. The RMD starts at 3.65% and it increases a little bit each year. One important thing to note here is that you only have to take out the required minimum distribution on pre-taxed money. That's the whole purpose of the RMD existing. So, if you're starting up an annuity with money that has already been taxed, say money from your savings account or a Roth IRA, you don't need to pay attention to the RMD. The following video gives examples to show how market volatility affects how your money will last.
Remember 2008? Sure you do. That was the year of the financial crisis, when the stock market lost nearly 40% of its value and shrank the assets that millions of baby boomers were counting on to fund their retirement. Of course, the markets rebounded, so no worries, right? Right? Well, it's true that during the years you're saving for retirement, if the market drops, you may have time to rebuild your assets that are subject to market volatility. But once you start withdrawing your money, that's when market volatility can have a big impact on how long your assets will last and how comfortable you can live in retirement. One factor in how big an impact is your sequence of returns. That's the year-by-year returns that your retirement assets continue to experience while you're drawing on them for retirement income. Here are a couple of examples. Say you're retiring with a nest egg of $1 million and you plan to withdraw $50,000 per year with a slight increase every year for inflation. Meanwhile, your remaining asset is still invested and still subject to the ups and downs of the market. Of course, we can't predict those ups and downs, your sequence of returns, but let's say that in your first year of retirement, you get a really good return. And the next year, you get another positive return. Not as good as your first year, but still positive. Then in year 3, well, a little less. And in year 4, ouch, the market drops and you take a loss. Now, with compounding, you'll average a good positive return over those 4 years. And that's what you want, right? So let's keep repeating that sequence of returns in the exact same order until your annual withdrawals have completely used up the asset. In this example, that's 38 years of income. But what would have happened if you had started withdrawing money in a down market? To find out, let's take those same 4 numbers, and this time we'll reverse the order. You still get the same compounded average, but this time you're starting out with a significant loss, then an okay gain, then a better gain, and then a really good gain. And as before, we'll keep repeating that sequence until your annual withdrawals have completely used up the asset. But in this example, it happens about 13 years sooner. You'd have lost 13 years of income, and only because you got the same returns in a different order. Of course, there's no way to predict the order of your returns, or whether it will be an up market, a down market, or a flat market when you start your retirement. However, there are potential retirement income solutions, like an annuity, that can provide protection against losses due to market volatility. An annuity can also be a source of guaranteed income for your retirement years. Remember, every additional year your assets last can mean fewer financial worries and a level of comfort. Yes, a long retirement is good, but it's even better when you have the money to enjoy it.
If you roll your 401k into a fixed annuity, it's a non-taxable event because you're not withdrawing the money for yourself. You're just transferring it from one retirement vehicle to another. It's not considered a distribution. You're simply saying that you want your 401k to be rolled over to another financial institution, which means it's still tax deferred. Moving your life savings from one account to another is a huge event. You need to make sure you have a trusted advisor or agent to help you. A great agent will walk you through the entire process. Our agents have helped hundreds of individuals move their retirement savings into the safety and security of a fixed annuity. Contact us if you are recently retired or have stopped contributing to your retirement savings account. We can show you your options to ensure that your retirement is as hassle-free and predictable as possible. This final video looks at annuity myths and truths.
Annuity myths and truths. There are lots of misconceptions out there about annuities. Some are outdated or just flat out wrong. Similar to how today's cars no longer have fins and today's TVs no longer need antennas, today's annuities have evolved from what they were years ago. Let's take a closer look at some common annuity myths, and then we'll look at the truths. Myth number 1. Annuities are too complicated. The truth is, even though the mathematics behind an annuity may seem complicated, as a concept, annuities are not rocket science. You give money to an insurance company, and in return, they give you a guarantee, such as a guaranteed interest rate, guaranteed income for a specified period of time, or even guaranteed income for life. Myth number 2. Annuities have hidden expenses. The truth is, any charges, fees, and expenses associated with annuities are not hidden away from view. Every annuity comes with documents for you to review, such as the contract and prospectus or statement of understanding that outline any charges, fees, and expenses. And your financial professional will explain them to you so you can make an informed decision before you buy an annuity. Myth number 3. Annuities have high fees. The truth is, while some annuities' fees may seem higher when compared to other products, annuities provide a valuable combination of benefits that those other products can't provide. Things like principal protection from market loss, along with guaranteed income for life with flexibility and opportunities for increases. The insurance company uses these fees to help support the guarantees made to you. And for a lot of people, that's a fair trade-off. Myth number 4. If you die while receiving income from your annuity, the insurance company keeps the rest of your money. The truth is, today's annuities offer options that let your beneficiary receive any remaining value left in your contract. A financial professional can explain how this works in more detail and help you choose an option that's right for you. Myth number 5. Annuities lock up your money so you can't access it for years. The truth is, though many annuities are designed to be long-term income products, today's annuities offer various ways for you to access the money if something should happen. Most annuities give you access to at least a portion of the money each year. Some annuities may specify a waiting period before you can access the money in them, but you can still withdraw money if you need to, though certain fees and penalties may apply, including income tax and tax penalties. Keep in mind, the longer you own an annuity, the more time the money in your annuity has the opportunity to grow. Think of it as baking a cake. If you don't follow the directions and you take the cake out of the oven early, it won't have enough time to fully bake. So to recap, today's annuities are more flexible than those in the past and can help you live your retirement the way you want. To determine if an annuity is right for you, talk with a financial professional.
All right, well, unfortunately, I'm limited by time. And as a token of my appreciation, everyone on the call will have access to a free ebook from safemoney.com entitled Retirement Simplified Roadmap. This way, you'll be able to grab a hold of things I wasn't able to cover in this webinar. Simply go to my Safe Money membership page by logging on to independentwealthplanner.com and scroll down to the ebook section. We actually have 3 books available right now. Feel free to download whatever booklet interests you. I've been getting a lot of positive feedback about these 3 booklets. Since I am a member, there's never a cost to you. Just let them know that I referred you. So where it says enter the name of the referring advisor, just type in Jennifer Lang and you can get the book for free. Also at safemoney.com, you'll be able to view articles and learn more about life insurance and retirement planning. We have loads of information and content available for free on this website. Simply log on to my member page, independentwealthplanner.com, to get access to all these resources for life insurance and retirement information. And of course, if you have any questions or would like to have a free financial needs analysis done, contact me via my website, wfginsurancequotes.com, and I'll be happy to help you. Thank everyone for attending, and have a great day. Until next time.
I've had this problem.
Big problem.
I really needed
a good insurance provider.
And I kept searching and searching.
There are so many choices.
It's really hard to find one that has all the things on my list.
But I finally did it.
Yes, yes, yes. Thank you.
If you were looking for one as well,
look no further.
Here's a really good one.
Just use mine.
Use mine.
I'm very satisfied.
Definitely recommend. Problem gone.
Thank you.